Welcome everybody. Thank you again for joining us today and taking your time to come and have the discourse with us as we learn more about the topics that we have set for this week. With that being said, again, I'd like to welcome everybody that's coming in and has already joined. And I'd like to now hand on to Karabo, who will then do the honors of giving us the infographic and then introducing our guest for the day. Thank you so much.
Okay, nice. Thank you, Tabuho. Thank you so much. Good evening, everyone. Thank you for taking the time out of your day to join us here today. And we have our special guest today, is also a financial advisor, Daniel. Daniel, how do you pronounce your name? You said Beyeler, right?
Yo, Beyeler. That's a 3 syllables. I know, it's an odd one. My bad.
It's okay. Yeah, so Daniel, I'll just quickly go over the infographic that we prepared for the group earlier this week, and then I'll just hand it over to you, and then you can just present your own work, yeah? All right, fantastic. All right, I'm going to share my screen now. Entire screen, let's go. Okay, Deborah, I'm gonna ask you if you can see these so that I know so that I can know that I'm on the right track. Can you see my screen?
Yeah. Yes. Sorry, I muted myself. Yeah.
It's okay, bro. It's okay. All right. So, guys, welcome. This is week 3. We're doing investments, and let's just get right into it so that we don't waste any more time. So we start with why investing matters. You're making your money work for you. Are you in South Africa or investing or abroad? Investing turns your income into long-term security. So there's like some reasons why doing some research, why investing matters basically. So we have one, inflation obviously is going to eat your savings. So investing helps you stay ahead. 2 is to diversify your portfolio in a way, spread risks across local and global assets. And if you start early, it's actually better, right? The sooner the better. And the goal obviously is to grow your financial freedom beyond your monthly income. So those are some of the reasons that we came up with. All right. So we invest in South Africa, right? How do we do this? The home-based opportunities, we can go to SA stocks or the ETFs. SA stocks, this is like things like buying shares, right? Companies like Naspers, ShopRite, MTN, you'll find these on the stock market. You benefit from dividends and also the capital growth. And then the second thing is the ETFs. So these are like the bundles of companies traded like one share. These are actually pretty good too. Most people would know about these as well. And yeah, how do we invest? You get them on platforms like Easy Equities and Cetrix now. I personally use Easy Equities. I think it's pretty good. It's just easier for me. So I bought a lot of my shares through Easy Equities. So yeah. So those are some of the platforms, and you're welcome to do your own research, obviously. And then the investment types, just to summarize, SA stocks, South African stocks, it's like medium to high risks, and it's ideal for long-term growth. You want to see your money growing over long term. And then ETFs are more low medium, right? Because it's all the companies at once, so like it's just much better. The risks, it's not that great. And then it's better for beginners, and also people want to just get some diversification, basically. All right, then we're going global now. The reasons for this, why you want to invest offshore, you want to protect yourself against like rand weakness and also gain access to global growth. How do we do this? You open an offshore account, or you can use any of the South African brokers offering global ETFs. You can choose things like S&P 500, MCSI World, and then you can just reinvest those dividends, for compound interest, basically. And this is a quick compare box. I don't have to go through that. It's fine. There's the local ETFs. This is offshore. Obviously, we know local is rand-based, and then offshore, you get access to other like currencies like the dollar, the euro, etc. Right? You're welcome to, again, do further research on this. And then the last one would be TFSAs, right? Your secret weapon. So we've heard about these. Many people already have these, I'm sure. So you have to contribute per ID. You can contribute like 36,000 per year, and then 500,000 over a lifetime. there's some benefits to this because then you pay no tax on the interest or the dividends or any capital gain, right? And yeah, many people actually register different IDs so that you can just have a multiple beneficiaries in a way and be able to just like take advantage of this, you know. So yeah, TFSAs are pretty good and perfect for us working overseas. You want to keep like a long-term SA investment footprint, basically. And then what else? Let's go. And yeah, that's it on my side. Thank you so much. Just summarizing the infographic for the week. I will stop sharing and I will just hand it over to Daniel. Thank you. Okay. All right. Yeah, Daniel. So yeah, we're done, and the stage is yours, and you're welcome to introduce yourself and tell us about yourself, and then
Appreciate that. Thank you so much, Karabo, and good afternoon, everybody. Really appreciate the time and the opportunity to chat to you. So my name is Daniel Beyer, as you heard. So I'm actually based still in South Africa, so good old sunny South Africa in Pretoria. And I've been a financial advisor for the past 15 years. And I've actually done quite a bit of work with expats and individuals that are working overseas and have a common plan, common ground, and understand your financial planning, your options. So I'm also a KI for the Liberty Group. So my carrier, as I like to say, is with Liberty. And I'm a branch manager for a franchise called the Financial Specialists. So within the Hereford Group space. So just to give you a whole bunch of stories there, but nonetheless. So Shem, I was actually contacted by Hazel and by Karabo, who mentioned this incredible group of individuals that are coming together and really hungry for knowledge and hungry for the ability to create a platform to learn and grow your financial plan, your wealth, either it's generational wealth or, setting up how to or pendulum from the opportunities you've now gained and, created for yourselves overseas. And so there were some topics that were brought together, obviously investing, wills, and also trusts. So what that all talks about is obviously a lot of understanding the vessel, the container that you're physically using, and then where do you actually go and put that money, right? And how do you plateau from this? So yeah, I'll also be sharing some screen. I've got a lot of information. A lot of it I'm more than willing also to share after the session, or, I'll send it through to maybe a central point that can be shared across. So ultimately, it's very important to know, and I wanted to make it clear that all the parameters information I might share will have sort of a carrier's logo like Liberty, but the advice is impartial. This is about you gaining information and learning what you implement in your own personal financial strategies, your own family requirements, your own specific requirements. And even I'm also open to individually assessing your own situation to identify what is going to be the best version of all these financial products and financial opportunities that exist to you, and how to best plug that into your financial world. Okay. So maybe as well with questions, I'm not sure what the general rule is. If you guys all want to sort of note it down in the chats, maybe if you wanted to keep it till the end, or would you like to ask as they come up? I feel, yeah.
We tend to normally ask questions towards the end, but I think even if we can still maybe some of them post them in the chat, that could work. But maybe it might be best to just jot them down somewhere and then ask once you've done with the presentation.
Perfect. I think that's absolutely brilliant. And I think as well, just two sides of the same story, right? There's no such thing as a stupid question. Ladies and gentlemen, please ask. This is a time to learn, time to feel humbled enough to, because one of the big things I'll always know is you might feel comfortable to ask a question. 10 people in the room might not, and they actually need the same answer, and they're asking the same question. So be brave, be bold, ask a question. And even if you, from that question now have more, if it's not the platform, you want to make it more personalized, we can always lean and go in that direction. Yes, Celeste?
I do have a question.
Sure.
It's two, actually. Good afternoon, Daniel. Right. So is it better to invest to buy in a house, because everyone this side, okay, let I not generalize for everyone, because the people that I've encountered with, they want to buy a house or to invest in easy equity. And because we're all going to go home and we don't want to live with our parents. And I know with
Yes.
living in our house, that comes with pros and cons, like paying the bond, rates and taxes, and things like that. And then my second question is, for the savings accounts in equity, is it better to have a money market account, because I know the interest rates are different and the access to funds are different, or do we need to have like the savings equity account? I don't know.
Perfect. No, thank you, Celeste. That's a very, very powerful question, because it's so important. I can only imagine exactly. This is a very complex question, because there's a lot of factors that actually get considered to define which one actually works right for you, right? And so we'll talk and analyze all the pros and cons of each options, because somebody might have the solution in their own world that makes one option actually better than the other versus. So we could definitely break through that and try and discuss that. Thank you so much for that. So it's obviously about the buying property now versus building up the capital and buying when you go back type of thing. And then also with money markets versus, say, other asset classes. But I'll explain all of that. Thank you so much. Excellent. So that's on the investment side. I like that. So let's throw ourselves right into that. I like that. Okay. So I think the big thing as well, let me see, I want to just see if I can start sharing screen, and I want to go into presenter mode and share screen. One thing within this particular space, while I'm in presenter mode, I might not necessarily see your hands come up. So if somebody could just facilitate that, if there's a question, put your hand up, let somebody call it, and then unmute and ask a question, unless we save them for the end, okay? So this is actually what we call the tax guide. So this is a public document. It's basically a compression of all the laws of SARS in South Africa and what you need to know about it to be able to make informed decisions about tax avoidance. Tax avoidance is legal. Tax avoidance is using every opportunity possible to reduce your tax rates while you're working in South Africa, abroad, whatever the case may be. And so that's why I just brought this up. But I'm going to leave it just on this white page for now so we can have a bit of a chat. So when you talk about that question, property over and investing, right? Now, let's look at our own context, our space where we're in. Currently, everybody on this call, I assume, is working outside of the borders of South Africa, right? You are in a foreign country, it would take you 11 to 13 hours to get back here. So there's going to be some level of reliance on an individual, whether it's a company, like a management company for rental, or family members, to monitor, maintain, and secure that property, right? So brick and mortar, that's when you buy, right? So one of the big things is obviously rates and taxes. So you're responsible for paying tax on that property, whatever its value is. That is quite higher than your investment taxes, depending on what opportunities you use, number one. Number two, to protect that investment, right? You know, I say register a bond. You're paying the bank, you've got to get bond in cover, obviously, to protect that bond. If you pass away, then at least it's settled, generational handover of the asset. One of the big things that gets added to your estate, because it's not your primary residence. Currently, you've got a work visa saying that you're living abroad. So that's going to form part of the estate and can attract estate duty taxes, right? When it's your primary residence, the first 2 million is exempt from estate duty tax on value of that property. So that's already one of the big risk factors. Another one would be like the idea of who's monitoring that property. If you get a tenant or a rental company to manage it, they will charge you 10%. So if you're getting 15,000 Rand a month on rental, there goes 1,500. You also still got to pay the bond, the water and lights, because that's going to be part of what you built into the rental agreement with the tenant. And now, if that tenant doesn't pay, you're exposed to the bond. Okay? If you're sitting in a foreign country, you're going to have to liaise between individuals trying to figure this thing out. If the tenant breaks something, there's a repair that's needed, a geyser blows, honestly, they break literally a granite countertop in a kitchen that's 5 centimeters thick. I've seen it before in trusts that I've been managing where there's rental properties involved. You're going to fund that because you're the landlord, right? If there is illegal activities taking place in that property and the police, you are liable. You are the landlord. So the amount of risk that you carry from a foreign country, very challenging to manage. Also, if it's being in your personal name, that income is going to be added to your taxable income. We're currently now you're working abroad and you've got double taxation concerns. If you're now starting to get an income in South Africa, plus that income, it's going to trigger and you're going to pay more tax. There's a very good chance you would actually end up funding that property and not actually growing it. Some of the big things as well about property purchasing is when you look at a particular location, an area, right? Like let's say you want to buy in a particular suburb. While you're abroad, things change. A new housing development could start up across the road or down the street and suddenly devalue that property. The upkeep of the suburb, the neighborhood. So it does put a lot of, depending on your contract, how long you plan to be out there, how long you plan, there could be a change in the area. And by the time you come back, you might not even want to live there anymore. Life changes. So I think once you really have a more concrete vision of your life space on returning to South Africa, would actually dictate the value chain to actually buy property. I think the big one as well is if you're buying it in your own name versus now registering either a PTY, LTD, a company, or even a trust, right? A trust while you're alive. So some of the big things, and now this talks about structural planning, financial structural planning. When you are looking at a property, buying it into a trust, all income generated within a trust is taxed at 45% in South Africa, right? It also needs audited financials. It's its own entity. It's a separate thing, right? So, and it doesn't have a heartbeat. It's not a life connected, so it will never end. So that's the beauty of it being a generational wealth protection plan. Like you build this entity. And so the idea is something like that to really justify the cost over security and value. You really want to be looking at assets over 20 million Rand going in there. You would also be paying for transfer duties. So if you've got current assets that you want to now transfer into a trust, and this is a trust that we call, the Latin word is inter vivos trust. It's a living trust. It's while I'm alive, I set this entity up, this thing, and now I'm going to take my own assets and put it in there. Okay. Do you pay for transfer duties for that to take place? What does happen though is you have a loan account. So the fact of the matter is that trust still owes you money out when it can do that. PTY LTDs, right? So that's a private registered company. That is taxed on profit and at 27%. If your turnovers are below $1 million in a year, you can even apply for a micro business and you tax that like 7%, right? And the kicker about that is that you tax on profit. So if you've got a rental property inside a PTY LTD and you register a property company, that's its purpose. You are a director. You could register family members as directors as well for generational handover. Then only your shares in this company are subjected to your estate on passing. So via the will and testament in your estate. So that can also reduce the amount of money that is actually exposed to taxes in South Africa. But you can run expenses like your medical aid, your cell phone bill, petrol, a couple of restaurant bills, a plane ticket there and back to come and visit to see your property. You see, because now you're suddenly a director, a business owner. Those expenses could run that property or company's profit down to nil, and therefore no tax is payable. So if you run that correctly and manage it correctly, you could really actually create something that you benefit from solely, which is obviously its intent, and have the ability to have that hand over to a generational wealth creation. Okay. But again, you still sit with the same problem about property management and property risk. If you also need some capital, you can't necessarily take a 3-bedroom house, sell off one of the bedrooms in bricks and get 80 grand for it to deal with any financial crisis or emergency. It's brick and mortar, So investment properties should not be bonded. I know it sounds crazy. That's how the vision is to build this, because it's free money from the bank. But ultimately, the value chain is on everybody who is now benefiting, which is that the finance institution, that is, where you're getting the bond from, they're making interest from you. Management company making interest from you. The insurance companies protecting that asset short term and long term. If you've got bond cover for life insurance, or you've got short term insurance to cover the roof and structure and things like that. So at the end of the day, the value is really stripped. And especially when it comes to residential property in South Africa. The rental market, think about it like this. Let's say you purchase a flat of, say, 500-600 grand. It's a 2-bedroom, 1-bathroom, little unit somewhere. It's the rental market looking for that space. Most likely going to be a husband and wife, right? Or partners. They both work, right? They're both earning income. But they're most likely the most subjected to cost of living crisis. They're going to be the ones most subjected to retrenchment potential, things like that. And all that does is create extra levels of risk that you have put your money in line for. Okay? So it's very crucial thinking. If you're going down this route, commercial property is something that's very attractive. When you buy a factory or a building, buy them on auction, obviously a lot bigger monies, but at the end of the day, it's stuff that you don't have to make pretty. It doesn't have to look pretty. It just needs water and lights, and the keys go to them. And sort of there's capacity for larger numbers, but you got to build to get there, right? And so that's where your investment lines come in. That's where you've got the platform to be able to take part of your disposable incomes that you're currently earning and build up capacity, build up opportunity. That's literally what it comes to. Now, also liquid-based investments, so that's paper-based stuff, right, as I like to call it. They are based on what we call asset classes. So I'm not talking about the vessels, the structures of things. I'm just talking as in general as how this thing and these models work. So you get a thing called equities, properties, bonds, and cash, right? You get local in South African terms, and you're also getting then offshore. Equities, and just like Karabo implied and explained a bit in his presentation, equities are when you purchase partial shares or shares into listed companies that are on the stock exchange. So in local terms, it's the Johannesburg Stock Exchange, the JSE, right? Then property. When you, at this scale, we talk about listed property. So what we call a REIT, Real Estate Investment Trust, REIT. That is when you invest in companies that build shopping centers, skyscrapers, right? They manage massive portfolios, and you can buy shares into that company that enjoy incomes from rental, from tenants, appreciation of land, that kind of thing. Then you get bonds. Bonds are released by your parastatals, so government as well as your financial institutions, the banks, things like that. It's normally a set term investment where there's a time frame. You invest, you get a interest return at a certain rate, whether it's annually, biannually, and at the end of a term, you would get your money back, right? Sometimes the word capital bond is used. In the banking sector, they might use the word fixed deposit. That's all what these are basically, it's bonds. And then you've got your cash market, which is your money market accounts. So money markets are linked to interest rates. So what is happening on the interest rate scale? Currently in South Africa, interest rates are on the decline. So your money market rates are also on the decline, right? One of the big things about a money market, savings accounts and those kind of things is that the bank is giving you inflation plus 1, inflation plus 2. So maybe 5 or 6% return, okay? That is subjected to interest, because that is interest. That's how you earn. That is added to your annual income in South Africa and taxed as such. There are some exemptions. So even though you're getting a low return, they're still stripping it because of tax, because it's seen as interest. Now, your most aggressive high-risk area is your equities, where your lower risk is your money market accounts, right? So that's your cash markets. Depending on each individual person's needs, right? You all have a different requirement to balance these asset classes. So somebody who might be 21 years old and is saving for their retirement, they're creating that plan C, that little back end to ensure that there's passive income creation at the end when we're 65 or so. They are need to be exposed to high growth assets because you can use time in the market to actually generate. It's not just timing the market. Where somebody might be in their late 50s, early 60s, and they say, you know what, we need to sort of start protecting what we have, but also need some growth. We find a bit of a balance in between that and call it a risk profile that is moderate. So, and then if you have a desire to spend an amount of money, maybe you got to book and pay for flight tickets, and that you got to spend within the next 6 months. Then you want to make sure that money is definitely here at all times. It can't be subjected to loss because there's an expense that's going to be, this money is earmarked to be spent. But you don't necessarily want it just to sit around and froth and not make money. So then something like a money market account then makes sense because it's protected. It's not subjected to crazy market conditions. So that's really in a small nutshell about this property versus investing thing. You know, with investing, you are using your own money and building it up. You're not giving somebody else the interest, like the bank. The thing is, bank is giving you free money, basically. It's not for free. They're going to make an interest from it. That's how they make, that's their business. Banks are not there to look after us as people. They don't really care. I know it sounds tragic. We are a number on a spreadsheet. And for them, they buy securities. That's the business model of a bank. When you go with your cash to your money market account and they give you 4, 5, or 6%, depending, they turn around and take your money and go and invest that and they get 30%, 40%. How do they do that? Because somebody else has walked in the door and asked for a credit card. And then they're going to get 28%. So they say, sure, here you go. You can have this money. So they pay you, they keep the difference. So the idea is where you say, well, wait a second. Why do I want to be a customer of a bank when I can be the shareholder of the bank? Because that's who the banks are responsible to. And that's when you're investing into portfolios, companies, equities, those kind of things. Very, very cool question. So let's now start pulling up some things I think is very important, right? Any questions or thoughts from there, everybody?
Possibilities. I know whether grade 1 deny because I think.
Hi, Sam. Can you please mute your mic? Hello, Sam.
No, the grade 1.
There we go. Okay, great stuff. All right, cool.
Apologies.
So,
I'll just
keep no problem. It happens. Sure, that's fine. Let me show you something right here. So this is called a taxation agreement, double taxation, right? So there's always a big fear to say, if I'm being taxed already in China, why would I need to be taxed in South Africa? So one of the big things is, if you're there on a work visa, right? We're not actually now docile. We haven't moved from South Africa. Our tax residency is still in South Africa. When a visa or a document can be revoked and they say, okay, you've got to go home, and your home is South Africa, and you've got a South African passport, that's the exposure. That's what it is. If you've moved your tax residency outside of South Africa, which is by either formal financial immigration or actual immigration, and you renounce your South African citizenship, then you don't worry about tax implications in South Africa, right? So this is where there are some agreements that exist, because obviously you don't want this to be unfair or undue to people. Well, at least the country sort of said that. So when you are earning interest outside of South Africa, there are certain requirements to be able to be exempt, or you got to pay tax on that interest. Same as dividends, same as royalties. If you are an artist or a musician and you've got assets that are being purchased offshore, right? Like say a song or a podcast, content creation, right? Then there's royalties that are being earned. There's taxes related to that in the South African context, even if you're living abroad. So that's where a lot of this documentation comes in with holdings tax. So also when any company that you invest in releases a dividend. So assets that you own, like even in your easy equities, any space where you've got a company that releases dividends, which is their return to their shareholders, there's a bit of tax that is deducted. This is normally done in-house within your investment and handed over. You would see your returns net of dividends withholding tax, but it's still something that needs to be considered. So what I wanted to drift to, so this is withholding tax, double taxation, and with the People's Republic of China, there is a double taxation duty of between 7 and 10% on royalties, but dividends at 5% and interest at 10%. So if you are sitting with capital monies in your Chinese bank account where you're earning interest, technically and legally, you should be giving 10% of that to South Africa. So it's got to be declared. That's a bit of a scary thought, right? One of the big things about that then is also having to state what you're earning and obviously doing your income taxes here in South Africa, okay, as well. Now, how do you sort of then balance this out? How do you get away from this or how, in the legalist point, you know? And so that's where this paper-based investing thing comes in. And that's where your tax-frees and your endowments come in. So this South African docile investment. So now we're going to talk about the vessel. But I want to use this glass as a situation. So let me explain a concept. If somebody walks into your house and you offer them a cup of coffee, they say, yeah, sure, I'll take a cup of coffee. You're not going to give them a glass, right? And why not? We don't have a handle to hold hot liquids in this. It's probably going to release all the heat that you poured in with hot water very fast if it doesn't crack and break because of the hot liquid, right? So that's why we, over the bygone centuries, people have worked out, okay, we'll rather use ceramic or clay. It's baked in an oven. So now it's super strong that it will keep heat a little bit longer and be more comfortable for drinking their coffee. And in the same breath, if you offer a person a glass of water, even in the phrase we say, would you like a glass of water? We don't give them a coffee mug. That's only when we were students in res and there was nothing left. Then a coffee mug to use. But the fact still stands. And there's particular reasons for that. Maybe that's clarity. You want to see the water, see that it's clean, that there's nothing funny in it, that more elegant, things like that, right? So let's talk a bit about these vessels. So, and this is where it becomes quite important. So I wanted to bring up some product information. Please bear with me. Again, it's just, I want to talk about this in general. I'm not marketing a business. This comes down to all your products that have these names. That is what these vessels imply. And so like Karabo was mentioning about your tax-free savings, it's a very fantastically efficient tool. So number one, you will find them pretty much on any financial platform that you have that is located with South Africa. So your banking apps will have it, easy equities, all the big financial institutions as well. They're all going to have this vessel. So what does it mean? But where does this stem from? South African government said, we are not a saving nation. We like to spend. When we're happy, we go and spend. When we're sad, we go and spend. When we're in between, we sit around thinking about spending. It's just what we do. So to try and change the narrative, the whole idea was to say, okay, let's incentivize South Africans, people, South Africa, to save up and invest. And so they did this. They created the tax-free savings account, tax-free unit trust. As long as it starts with the word tax-free, you should have then this right. Okay. You can contribute up to 36,000 Rand a year in a tax year. So 1st of March till the following Feb. Okay, it's not a calendar year, it's a tax year. Then also, you cap to 500,000 Rand in lifetime contributions. That's money in. These are all monies in. So you can figure this out. 36,000 is capped. That's 3,000 Rand a month if you had to have it as forced savings. But you're also not restricted to that. It can be a lump sum once off in that year, irrespective of how you get it in. You could do it at 1,000 Rand a month and then EFT the remaining 24,000 as a lump sum. Irrespective, it doesn't matter, okay? But if you stay within those bounds, you will not pay any tax on the capital, the growth, or effectively. So no dividends withholding tax, no capital gains taxes, nothing of the sort. If you maximize those contributions per tax year, it should take you about 12 and a half years to maximize it to get to the 500,000 capped. We do expect that 500,000 and 36,000 to actually increase over time. Currently, this is the same percentages as been since it was pretty much released. So nothing, but there should be inflationary relation happening. If you go over, and this is where it's very important for you as the investor to take control of this scenario. If you go over by even R1, they will penalize you by doing double taxation. Even if it's accidental, there's no comebacks here. You may go, oopsie, I put in the wrong account. It throws you right under the water. So capital gains tax is currently at 18% after the exemptions and on growth. They will double that to 32%. Whenever you withdraw, that's when you sell the asset, and that's how capital gains works. So I always say this, maximize your tax-free investments first, before you do anything, because you have it available to you. So if your budget is, let's say hypothetically, 5,000 Rand a month, you put your first 3,000 Rand a month into your tax-free, and then you look at your other vessels, because this is a great way to reduce as much investment loss as possible. Okay. Now, the thing is, you get a tax-free savings account, like at the bank, and like you see on this document here, that is going to be linked to now maybe something like your money market account. Okay. Problem is there, that's a very low base return, 5-6% based on interest rates. Where something like this, you can get a tax-free unit trust, where you could potentially invest in offshore portfolios or, that are Rand docimiled. So like, as an example, you can get access to NVIDIA, Facebook, or then the Meta platform. You could be in Apple, you could be in Google. And actually, if your intention is to let this run for 20, 30, 40 years, you could build this thing up to like a real content. And you can access that even post-retirement as a good flow without tax. Every year you grab what you need in income. You can make changes, portfolio switches, whatever the case may be, but you're not exposed to taxes. One of the big things, though, about a tax-free is that they're governed under the Collective Investment Schemes Act of South Africa. Same as your unit trust, a standard unit trust. That means that there is no nominated beneficiaries on these products. They go directly into your estate and they can add liquidity. The problem is there it is actually can be subjected to taxes, estate duty tax in your estate. So having a structure and like your testament planning is really important when you start looking at how you look at vessels for your investment planning. Okay. So once a person has actually maximized a tax-free account, then you get your, I just want to go past this. There should be it's at above, investment account. There we go. So we call it investment account with Innate, but this is now a unit trust, a standard unit trust. This is where there's no limitations. You can have full flexibility, money in, money out. If 1 month you want an EFT directly, a lump sum, you can withdraw after tax or like a clearance period for money laundering. So there's, once money goes in, it has to sort of sit a bit, make sure that it's not dodgy money, and then you got full access to it. So you can have a monthly recurring payment to it. You can stop it if you need to. You can reduce it. You can increase it. And you're not going to be penalized or charged for those kind of transactions. Okay. Within that as well, you have the access to invest in local or offshore Rand docimiled, quite frankly, even offshore fully, if you needed to. Also adds to your estate, so on passing away. And these are subjected to capital gains tax, for sure. So let me explain this capital gains. You come with, let's say, 100,000 Rand as an example, as a lump sum. You buy into a portfolio, right? That's where this mix of equities, properties, bonds, and cash is taking place. That is called your base cost, the day you bought it, the value of the shares or the units you bought into. Now you leave that to invest over some time. Now you decide to sell it, right? To turn it into cash again, back into your bank account. Now that's at a higher price, okay? That's your sale price. The difference between that base and that sale price, that is called gains. You get this on investment properties as well. When you want to sell the property, you get this on business assets. If you've got, let's say, shares in a private company and you sell, or like this in this platform, okay? Of that amount, in a tax year, natural individuals, you and I, first 40,000 is exempt. So you don't pay on for the first 40,000. Whatever is above that, you're subjected to 18%. So that just gives you an idea of that tax capacity. Now, here's also a strategy people would use to say, you know what, if I invest capital, build it up for future retirement or future income needs, say whatever the case may be, at that stage, you don't need to withdraw the full lump sum out to now start using it. You can grab what you need and stay within that threshold of exemption of that 40,000 on growth based on what you're selling of the base cost. So you could potentially even not even have to pay capital gains tax, depending on your withdrawal system, what you're looking for. When you start talking as well about the idea of what Celeste brought up, buying a property or investing in something like this, where you're building up your capital. So when you want to build up your capital and you might be subjected to capital gains and you want to use this money to buy a house, say in 5 years, 10 years time, that could be a bit of a problem if you're going to be subjected to that tax in your own capacity. So there are other vessels, depending on your time frame, that could suit you better, and also depending on your own tax rates. Okay. So again, that's why we say it all is dependent on you as an individual person, what your needs are, what you currently have, what are your dreams and your goals, and when are they supposed to take place. Okay. Then you get a thing called an endowment. Okay. I'm going to scroll down here. Endowments. Okay. So an endowment is actually, it's like starting a life policy. It's registered under the Long-Term Insurance Act of South Africa, not the Collective Investment Scheme and Banking Act. So what this means is you are a life assured and owner, not an investor, but you're still getting the same concrete. You're getting a vessel, you get portfolios, money goes in. Taxes are dealt with inside the funds on your behalf. Equities are taxed at 7%. Properties are taxed at 14%, and your money markets are taxed at 30%. So when you hear that, you go, but that's crazy. And exactly. That's why this tool is not effective for somebody who's looking to save for the short term in something that needs to protect a money market account, because that's going to be taxed at that rate. If you've got interest at a bank and you're paying 45% tax, there you're paying 45% of that interest because you earn that as an income bracket. So this is even lower than that, but nonetheless. The only thing is here, there are some restrictions. Minimum term of 5 years. You commit to pay your premium, whatever that amount is, for the no less than 60 months. Okay. After that, it's open-ended. Then you got the capacity to pause, withdraw as much as you like, things like that. But in that first 5 years, you, like I say, you also cannot add extra monies. There are some money laundering restrictions. So you've got to get it in as a monthly income or a monthly amount, or these could also be started with a lump sum or a combination of the two. But there are nominated beneficiaries here. So should you pass away, this money stays outside of your estate and goes directly to the people that you want it to go to, right? And so when you've got a goal or an idea of, let's say, I'm working in China, I'm going to be here for at least 7 years or, whatever the case may be, I want to build up as much as I can so that when I return back to South Africa, I'm going to have everything I need to set up this life vision that what's driving you to be there in China for 7, 8 years, right? A combination of these product lines and these vessels is what's really going to help you to effectively be in control of the greatest outcome for when you want to come back, if that's the case. So like maximizing tax-free growth and knowing you've got access there, if that's important. A unit trust is great for excess amounts or emergency savings. The ability where you need to get your 3 to 6 months worth of your basic income expenses put aside so that if there's that you've got access to it and be able to deal with it without having to go into financial stress and distress, especially in a foreign country. And then your endowments are really, your structure that's going to allow you to have untaxed capacity in your hands, really build up some capital and have access to it, but protect it in an environment that if anything has to happen, you're not going to just now throw it all into an executor's hands and pay taxes on passing. So yeah, Then obviously there are other investment vessels, various particular purposes, things like your retirement annuities that gives you a tax deduction in South African terms. So if you are still having a tax income that's linked in South Africa, there's a strategy behind that. If you're looking to build that up or not, again, it's all dependent on your own personal requirements in your life. It also really builds a nice safety net, knowing that there's plan C back there. A very important one as well is if you've had pension or provident funds at previous employees when you were in South Africa, right? Those monies, are they being managed correctly? Are they being looked after? There are things called preservation funds where you can get them out of the hands of the previous employer who's probably never going to phone you and look after that thing, and actually put into a vessel that you can manage and actually see and control and be in control of. So there's also capacity there. So that's really when it comes to your investing and the vessels that are available sort of in the African term, the African market space of what's going to work best and their value chain to individuals. So
Hi, Daniel. So sorry.
Yes. No, perfect. Yes. Questions. Bring it on.
Yeah. So we're about to go into the Q&As, and we're going to open a new link because we unfortunately out of time for this one. So I knew that maybe you wouldn't be able to see the messages. I'm sure Hazel sent you the new link.
Okay.
So just
perfect.
everybody to log on to that other one, and then we can do the questions on the other link, please.
Sorry about that, but awesome. Thank you. I can chat away.
Yeah.
It's okay.
On the current one,
It's okay. I've already seen it
okay.
as well.
All right.
I've already sent it to Daniel. Yeah.
Okay. I was just gonna say that on the current link, we still have plus or minus 6 or 7 minutes left. So he could maybe go on for the next 2-3 minutes, and then we can close this one, so we can start a new one. Then you can take the questions if that's okay.
Or maybe just give this time for people to just log into the new one, right? So then we don't have to.
Let's go to the new one.
Yeah,
I think that's a great idea. But thanks for the suggestion.
Okay.
Then we're not limited.
All right.
Yes.
I'm gonna have to close this one then.
Yeah. Everybody leave. Wait for the new link.
All right.
Awesome.
Yeah, I'm just allowing everybody in. I've also sent the information for the ones that want to log in. Old school. Oh, that was my timer going.
Very, very good. I actually want to just set up something that's quite nice visual.
Hi, Debo. Can you hear me?
Yeah, I can hear you.
All right, nice. Hi, Daniel. All right. So,
Hello there. Yes. All good.
Yeah. We have 15 people. We can just maybe wait like 5 to 10 minutes for the rest to come in.
Absolutely. I'm going to perform something in silence. So it just also is nice for just a visual assessment of like portfolios and the concept of the sooner you start, the better your returns can potentially be as well. It will remain cheaper for longer and things like that. So this is a particular tool that I have available. It's called Full View. This allows us to assess and analyze investment portfolios from multiple institutions and sort of assess and what are the risk implications and so on. It's actually quite a nice tool. So what I tend to do, like especially for an environment like this, is sort of select some of the big flagship, the very highly marketed product, like investment portfolios. Okay. Because I also want to explain what an investment portfolio looks like and what documents, what information can you get to empower yourself while you're trying to assess this, let's say, on your own versus leaning against, advisory services. So it's let's take a look here, and then let's also do money market account.
Okay.
This amazing. Is this available to the public, or is just for financial advisors?
Yeah, unfortunately not. So it's not available, but I'm more than willing to do this for each individual person. If you have a current portfolio and you wanted to sort of look at what that means and what it can do, and exactly, it's a tool that can be used.
Okay. So, sorry. Can you unmute your mic?
I'm in. Not saying you right, saying again. No.
Sorry,
guys.
There we go.
Yeah, because I kind of muted all because there were people that were just having a discussion at the back and we couldn't hear you. Hey, Karabo, you need to unmute your mic as well.
Yeah, can you hear me, everybody? All good?
Yes, sir. We can hear you. I was just saying, Daniel, please reintroduce the platform. When everybody.
Definitely. Almost indeed.
Maybe I could ask this question while everybody's trying to join. With regards to the TFSA and the whole 500,000 lifetime and then the 36,000 cap, I've always been curious. Like, I only started doing the TFSA account this year, so I've been curious. Like, so if I actually max out the contribution, and then let's say I don't take out any money at all for the next financial year, does it
Yes.
by default starts from zero, or it doesn't matter that I've built so much? Maybe let's say my initial 36 grew to maybe a 50 or a 45. I don't know. It's just an example. Does that now mean that in the following year, and then I don't want to take out that money, when the government taxes me and whatnot, does it now automatically reboost to zero, or does it start from the 46 going up, or how does that function?
Yeah, no, that's a very good question. So what's happening in the background is when you open a TFSA, right, unit trust tax-free account, when you make those contributions with we call it a MANCO, management company, your financial institution, they are recording those contributions that you're making, right? So if it was 36,000, you've maximized it. The following year, it opens up that you got another 36,000. Now it's adding up. So let's say you get to a point where you've contributed 220,000 Rand in contributions, right? Now you withdraw. That the system is going to record that you have contributed already in your lifetime 220,000. So if you withdraw 50 grand, it doesn't mean that it's now that 220,000 in what you contributed reduces by the 50 you've taken. You only have a lifetime contributions of 500,000 and annual contributions of 36. So if you do not maximize your 36 in a year, it doesn't take away from the 500,000 lifetime. It just means it's going to take you longer to reach your max allowable lifetime contribution. So if you max the 36,000 per year, you're going to get about 12 odd years, and you would have then met the lifetime requirements, and then you'll have to stop contributing there. And so that's why I like to say that if you can max that and leave that to run for 20, 30, 40 years, you will have a game changer in your family's surname, quite frankly, and its value. You don't want to use these for emergency monies, quick savings. Because when you withdraw and you're taking away the ability to get more money in there and have it exponentially grow crazy throughout your lifetime.
So they usually be better for like kids, Daniel? Like maybe
Yes.
like a child, and then you know that you're saving for like university. Like by the time they're 18, 20, they can actually use that money. Yeah, I can see that.
So one thing is we're allowed to on that. Sorry, apologies. I just want to add that to Karabo. So when you want to do it in a child's name, it is best to give it under their own tax number. Okay, because you are a legal entity, you are the parent, right? Yeah. The guardian. Now you're starting a TFSA in your children's names or child's name, right? You go and register them for tax. They don't earn an income, but they need a South African tax number. It's a 10-digit number. That way, then it's in their name and you are just the legal signatory. So that when they turn age 18, legally can take over, then you basically change ownership and you give it to them. Or whenever you're comfortable giving it to them. It doesn't have to be on the 18. That's just legal. I know if my parents had to have signed me over an investment at age 18. Hey. You know what I mean? So, but maybe it's a case like you say, funding university, funding those opportunities, and if there's anything left, it's either a case of withdraw it or use it. But also remember, though, we are then maximizing their lifetime contribution. Say they will not have that opportunity for themselves because you put it in their name. Yeah. But theoretically, you've got one per ID number, one TFSA per ID number. If you're a family of 4, there are 4 South African ID numbers in there. So that's where that structural concept comes in. It's just about setting it up correctly and knowing that, one of the great things about it as well is if you pass away, let's say as the financial breadwinner in the house or the person contributing to these in everybody's name and you pass away, if it's linked to their own ID number, that's still active. So it carries on. That capital that you've invested in there is not going into your estate because that isn't linked to your death. It's linked to the death of the ID number. So what is important, though, is when you do put money out, because remember, you've been taxed on that as an income, voluntary money, and now you've invested it into your kids' or wife, spouse's investments, right? You should register that as a donation in your tax year. Now, this is where we're going to get creative. And so let me actually track back before I get into the screen you're seeing. I'm the tax guy, right?
Okay.
Donations. We as individuals are allowed to donate up to 100,000 Rand to a spouse and not pay tax on that because it gets added to their income world. So if you're a higher tax bracket earner, you can actually benefit by giving a donation into a family member, and a spouse in particular. Just donations tax, 53. So I'm just going to zoom in a little bit because I know it's a bit small. So donations tax is payable. Of course, Celeste, I like it when questions come up. Is payable at a tax rate of 20% and the value of any property disposed, right? So exemptions from donation taxes, donations by a natural person up to 100 grand per year, donations by corporation entities, donations between spouses. So to any natural person, 100 grand a year. So now if you've got your kids, 2 kids, 36, that takes us to 32, 72. Here, any donation to your spouse in-house. So then what's it going to do? It's going to reduce that you don't have to pay this tax. That's a great way, a great system to get money leveraged within the family unit that you still sort of govern and have control, visuals and so on, but it is going into their name. So legally that it will become theirs. Okay. I know, Celeste, you got your hand up first. Let's ask there.
I was about to say there are people with hands up.
Okay, I might sound too forward or something, but how do I choose? Maybe you didn't speak about it, but how do I choose the right institution for opening a tax-free savings account? And are there any fees associated with managing with a different financial institution?
Very good question. So definitely fees. So any investment, any vessel, any institution, there's a few layers of fees. And I think, honestly, fees, I will want to go in depth in a different session. Okay, because it is really a facet on its own to understand the lingo, what it actually means and what that implies and where's the value chain. But anyway, there's going to always be a portfolio management fee, right? So if it's the money market account, how much do they charge? If it's a Allen Gray this, a Coronation that, if it's Investex, Stanlib, whatever, there's going to be their administrator, that fee, the investment fee. Then you're going to have an administration fee. So the actual company like the FNB, the Nedbank, the whoever, that they do this thing. Then there's the potential also for advisory fees. So if there's an advisor, an intermediary in between those two. I know it sounds crazy, but even on easy equities, you don't meet a human being, but there is a broker fee there. So it's being costed. And so assessing and understanding what those numbers are, what is an industry standard, what is a proper level that should be expected like that versus, it's value chain to you. Again, costs and fees are going to reduce the growth of your investment. So it has to be either bringing more value than its expense, or it needs to be as low as possible so that the most value is back in your back pocket with its purpose. So yeah, if that's okay to understand, when it comes to choosing, listen, at the end of the day, I think it comes down to trust. That's really what it comes to. The picture on the top of the paper is just something. At the end of the day, laws govern these products. Laws govern what they're allowed to look like and be like. So they're going to mirror each other if you had to do an apples to apples to apples to apples environment. So if that is the case, it's more about saying, who do I trust to be accountable to report back to me? And if I don't have anybody I trust and I want to do it myself, then what am I as a person, what am I required to do to maintain that it can actually give the value I'm looking for? Some of the concepts I like to explain is, if your toilet is backed up, do you phone an engineer to come and check it out? No, you don't. You phone a plumber, right? And it's the same kind of concept with investing. If you are out there doing your work, you specialize in a certain space and field, you do this day in and day out. For you to now completely assess a whole new industry world and try and make the best assessments there to be able to benefit. And this is money, this is finance, that defines our future. Doesn't it make sense to sort of maybe get a professional involved that can assist you in that journey and be accountable to you so that you go be the cool person, awesome person you are in this world, and then have somebody to back you while you're building your financial freedom? And so I think that really is more of, you either got to find trust in say the service, the company, and the product line. If you trust the product, that's great. You're trying to figure out, how do I trust the company? And then how do you trust, if there is the capacity to do so, a person that assists you in that journey? So I hope that helps answer your question. And Hazel, yes?
Sorry, before Hazel can speak, if that's okay. There's someone who sent out a question in the chat. They said,
okay.
So I don't know if you can access it as well, but there's a question there from Peely, who was asking if the donation is limited to a number of people in the family.
The number of people in the family. So it's capped to that in a tax year. So so you could donate to 100 people, but then they're going to get like 1,000 rand each. But there's no limitation to that contribution. But you got to register it. So you actually go into SARS's website and you download this document, the donations tax document, and you would say there, I donated so much money to this person, and signed by both parties, and that is uploaded with your tax returns, so they lessen the burden of your tax year, knowing that you did that. And like it says there, between spouses, you could do that. I think a big one as well is depending also on your marriage contracts, so this is something very important as well, is if you're married in community of property. So think about also customary marriage in South Africa, lobola. Even if it's been paid partially, you are now deemed married in community of property under the traditional Marriage Act. Okay? That means even if you are sending money between each other as spouses, all the assets are ours. It's the estate. So if one spouse passes away, the entire estate has to be wound up. When you're married out of community and with accrual, everything above the date of marriage is basically seen the same as COP, community of property, same matter. If you're married out and out, then it's very separated. that's when something like a donation is taxed to maybe a house spouse or, somebody. That way you can mitigate your tax capacity, because if they don't earn an income, you earn 45%, you EFT money over, and that squares it out. You can actually benefit from that level. Okay. Yes, I see, Celeste, you've got a follow-up question about Hazel. Shall we come to you, Hazel? Do you want to ask a question? And then we'll grab you, Celeste.
Yeah. I have like 4 questions, so I'm going to ask one and then I'll hand it over to Celeste. So my first question is based on what I had done. So about a year ago or a year and a half ago, I also opened a few TFSAs for my family, like a few of my family members. You may have touched on this, but because I kept, losing connection, I'm so sorry if I ask you something that you've already spoken about. So I did open the tax-free savings for them. And I just heard you mention that, because I know it's capped, right? For me, I like every year I just like put on the 36K just for the peace of mind. But for their own, I basically just like invest monthly, the 3,000 rands monthly. So now I just want to ask, when it comes to the beneficiaries, I also have one of the people as well who already have their own tax-free savings. Like if I pass away, they are the beneficiaries. So now what I want to ask is that going to affect them in any way? That's the first question. And the follow-up question for this same question is, I've heard you mention that you can actually give to someone. Can I give someone who already has their own tax-free savings? Because I also at that time wasn't educated about the fact that I can give it as a gift. So I was like, okay, fine. It's limited, let me just have them open up their own, tax-free savings. So now again the question is, will it be affected if something happens to me and I have my beneficiary who also has their own tax-free savings? And another thing, some of the people that already have their own tax-free savings, can I later say, hey, I wanna gift you this amount, like you said, I think you said it's kept at 100K per year, if I'm not mistaken. Can I still do those things?
Mm-hmm. Very cool. Very good question. Thank you, Hazel. So if the person took out their own tax-free savings account in their own name, and then you started then a second one that's in their name, right? That person is going to be subjected to double taxation because you're only allowed one in your name, in your ID number. So that might be a bit of a...
I'm sorry, remember, I think you didn't understand that part.
No.
I have my own tax-free savings, right? My mom, like other people in my family, don't have their own. So I help them like create, but then the money is still... I still contribute, basically.
Great, yeah. But it's in their name, yeah. So their name, their ID number, it's just the source of funds is an external space. That's perfect. And then there's no problem there. Now, if you pass away, that money, like it says, their name, their ID number is on there, irrespective of the source of funds being paid in. They've been featured, they were whatever institution, and so that money isn't going to be called up into your estate. It's their money. The moment it arrives and clears into the investment and it's been received there, it's their money. Now, to just benefit from it as a South African tax point, you might just want to register when you make those payments as donations. And then you've got up to 100,000 Rand in a year. If it's spouse, there's no limit to the number. But if it's to external natural persons, 100,000 a year. So if there's, you're making to 2 individuals that you're paying, you can at least write off up to 100,000 in those, and the rest would then be subjected. So and what happens is just you're getting rid of 100,000 Rand in income that's being taxed, because the thing is there to be taxed or not taxed depending on their income capacity. Does that help you, Hazel?
Yeah. I got the other points. If I pass away, like I said, I already have my mom. I'm gonna use my mom as an Oh my god. Oh, okay. Let me calm down. Sorry. Let me slow down. Okay, so I have my mom. It's just that I have so many questions that I'm just trying to, articulate everything all at once. I have my mom as one of the people that I help create their own profiles when it comes to TFSAs, right? And I have my own tax-free savings, and my mom has her own. It's all under her own information, her own ID, and I also, when I created my tax-free savings, I put my mom as the beneficiary who will get a certain percentage. So if I pass on, and then obviously my mom would have to inherit, that estate. Now my question is it going to be, let's just say she exceeds, right? Let's just say she already has reached her own limit, and then she then accesses, she then inherits the estate that belonged to me when I was 5. Is it going to be like, is she going to be penalized? Is she going to receive this punishment of double taxation? It wasn't a gift. No. It wasn't. She didn't reach the limit, but she inherited, this estate from her daughter who passed on, which also was a tax-free savings as well.
No, that's fine. And that's the thing, exactly right. So a tax-free savings is not immune to estate duty tax. It's immune to tax on growth within the fund. So that's what they're saying. It's free of interest, it's free of capital gains tax and dividends withholding tax. Okay? When you pass away, that money now is going to be dictated by your estate on death. Okay? Now, all the capital goes into this estate, minus liabilities, and whatever is left then pays out to your nominated beneficiaries on your will and testament. Okay? If there is one. Let's say that's your mum, she's going to get that in her bank account as cash, not the tax-free savings account as its entity, as a thing, and like transfer ownership of name into her hands. She gets it as cash via the estate. Now she has it as cash. Now she decides what she wants to do with it. Does she now say, I want to reinvest that into that tax-free savings? That's her choice. Is it to settle debt? Is it whatever the case may be? I think even at that stage, people would look for financial advice to also try and understand what is the best way for them to use this inheritance. Because remember, that's what's called. It's inheritance. So it's not, you said you got beneficiaries on there. So I'm curious to see what you mean by that, because that's odd. But nonetheless, Hazel, I think as well, it sounds like we've got a bit of I don't want to say complicated, but there's a chain of structures that exists already. And we should most likely look at that in a very personal capacity, probably not on this forum, and just out of respect for your family members and details and your planning and so on. But it can definitely be a learning experience where we can maybe come back and share with everybody things to do with these structures, if it makes sense. Sound like a plan?
Yeah, for sure. I'm still going to book a consultation with you, so.
Absolutely.
Thank you.
Without a doubt. That's fantastic. Very cool. Thank you, Hazel. Celeste, yes, I know your hand is up.
I'm sorry, Daniel. I have a lot of questions.
Okay, no, perfect. That's fine.
I might sound inquisitive, but I'm trying to get the hinge of this. But yes, with the tax-free savings account, first of all, the interest and the dividends on capital gains earned, do I have to pay? That's the first question. Maybe you did answer it. I'll just go back and review the recording. And then secondly, I'm getting old. And will it affect me, the tax-free savings account, will it affect me, my overall tax situation, especially in retirement?
Good question. And that's actually why we want these in our lives, is because we do not pay those taxes as long as we stay within those amounts in contributions. So you can see, and like it says currently, so they could elevate. So, and contributions is you putting money in, as long as, and that's the trigger, you putting the money in, staying in these limits means that you are not subjected to any of those taxes. Dividends withholding tax would have taken place within the fund on your behalf, if anyway. So you wouldn't even see that money. It's just a reduction of growth. Interest. If you earned interest in the year and was paid out to you, you would actually receive a tax certificate from that institution. It's called an IT3B, interest earned income. You would have to submit that with your IRP5 document to SARS. That shows I earned this much in interest. Okay. Because also our assumptions are that the banks are always the safest place when we have large monies and I just want to live off the interest. That's when we're subjected to those taxes, right? And then capital gains is only payable on the sale of the asset because you're entering at a base cost, you're investing. The moment you make a sale, now we have a difference. We know what the gains have been, and now that is subjected to capital gains. But within your TFSAs, that is all eliminated as long as you stay within that, those contributions money in. That's the incentive for us to want to use these to save up for things. So now that's where the mentality comes in to say, if I have such a unique opportunity that I can not have to ever pay tax on the growth of something, I need to give that thing the best chance possible to become and be worth 2, 3, 5, 10, 20 million rand, right? That's why it's such an important thing for very young individuals, because you can access this thing, flood it as fast as best capable possible, and then forget about it. Just manage it and let it run. Because then you know that all that growth is untaxed and it's just there for you. And even when you want to use it, it's untaxed. That's really why you want to look at how this starts off your model. But now, if you've got something like the need for building up your emergency money, 3 to 5 or 3 to 6 months worth of your current expenses, don't use this for that. Rather use a normal unit trust or a savings account, because then you'll be under those tax thresholds, but you're not like stealing from this facility. You want to try and use this thing for a very long time if you can. Okay.
Okay.
Awesome.
So I don't know if Celeste wants to say anything more, but there's a question in the chat as well from Zakiti. She said, if I open a TFSA for my 60-year-old mother, what happens if she passes away?
So it would add into her estate. So if this is the thing, you opening it up in her name, her full first name or full names as per ID, her ID number, her tax number. You putting money into it. The moment it clears, that money is not yours anymore. You've given it to her. It's in something that is in her name. It will form part of her estate. So if she passes away, then her will and testament will dictate where that money is going. If her full estate is under 3.5 million rand in value, then there's no executor's fees. There's no estate duty, taxes, everything above. But so if mama is below that amount, you know that there's no taxes like that, but there'll still be an executor's fee. So if you are 100% sole beneficiary of her estate, then you would basically get it plus everything else. But the fact of the matter is you would not have control over that truth. If mom had a secret boyfriend that nobody knew about and, wada, and you're going to find that out in passing, well, cheers. You don't have a claim. You don't have anything to state. So to sort of make sure you get some level of benefit for that contribution out into that person's name, register as a donation so that you're at least writing off some tax. But at the end of the day as well, you shouldn't be putting it into the person's name with the intent of getting it back. Because ultimately, you do not have control of that money because it's in their name in something. Unless you've got now some verbal agreement or you've got some document. But at the end of the day, it's also a bit of a jippo of the system because that's its purpose. If you want to have continuous 100% control and ownership of money, you should not be putting it into somebody else's name. You understand what I'm trying to say? You can invest it, but you want the vessel where your name and ID number are there as the investor, the owner, member, the life assured. That is then your money. The moment you put in somebody else's name, it is their money. That's why we talk about it's good for children and children's investments, because you are the legal guardian. You are the entity. You are the signing rights of that. So you are in control of that money. I hope that helps that question.
Yeah,
also,
she said she understood.
Excellent. Yes.
Sorry,
Well,
quickly.
no, yeah.
There's another. I'm sorry, guys. Apologies. There's another question in the chat, real quick. The person is asking that if I have 2 TFSAs, can I transfer one to my child? But I'm of a notion that you are only allowed to open one TFSA, because if you open with another entity, their system will flag you that you already have one. Therefore, you cannot open another one. Correct?
You hope so. There's no flag thing though. Some maybe if there is an institution that is actually caring about humanity, yes, they'll flag it. But no, there's no. There's no obligation.
I'm saying that because I remember from my personal experience, I opened a TFSA with I think with Easy Equities, but I never used it. And then I started using it. But then prior to that, I actually went to Discovery to try to open one, and then it kept saying system error. And then when I spoke to them, they're like, we think you actually have another one somewhere. Are you sure?
Excellent.
And then that's when I checked, and then I realized, oh, I did actually open this, but I never used it.
Yeah, you see. Good call. So that's why I say that I have seen it where people have multiple TFSAs and they didn't understand this. No flag, no system, nothing. And they will be subjected to caps or double taxation. So then it was a case of saying, eliminate, or basically sell out, get the knock, take it on the cuff, and run with the one that you got that has the potential to do the most value. So, but that's why I say so. But I guess it's also because I think Discovery and Easy Equities has maybe a link to them to some extent.
Yes,
there is a
do.
connection systematically.
Yeah,
and then that would have helped.
Yeah, Easy Equities has a link with Capitec and Discovery.
Correct. Exactly. And I think they're also bringing in Luno now for something. But yeah, at the end of the day, though, it is on you. The onus is actually on the investor. And you can't, in all other words, like selective amnesia doesn't work here. SARS is very clear about that. You get one in your own name, and you've got these limits. That's it. Take it or leave it, type of thing. So yeah, you are able to transfer a current tax-free savings to another institution. But you see, and there's very important rules or things that have been noted in that environment. But to merge them, no, you're going to end up paying that tax on both of them because they're going to be recognized. So, yeah. Okay, cool. Let's get some of the hands up. I think. Yes.
Yeah, I'm going to say.
Yeah. With that, sorry.
Can you hear me?
Yeah, we can.
Yeah,
hear
we
you.
can. Number one.
Just want to make people aware that we have 25 minutes left. Okay.
Okay, on my side, I want to know how I can put this question, because now what you said just triggered something, right? So I'll make an example with myself. Back in varsity, I had a TFSA, right? And then at that time, I didn't have the knowledge of how it works and how it's done and whatever. And now as an adult, I don't know if I have multiple ones, because I also did unit trust, whatever, with NetBank. But now, as you're explaining, I'm like, okay, there's a threshold. I didn't even know if there's a threshold or whatever. How are you able to track or to see if maybe you've reached your limit?
That is, the onus is on the investor. So some of your newer platforms are building that into your reporting. So when you get a quarterly statement or whatever the case is, they'll say this: you've reached your annual limit, and this is how much of your current lifetime limit you have contributed. But like I say, there are silos. These guys don't have obligations to talk. They don't have reason to pick up multiple ID or an ID number of one person across as a client at different institutions. So they are in the business of making money. Right, like a net bank and this bank and that financial house and this and that and whatnots. So for them to have a system that flags it, that's actually very nice. But they don't have an obligation to that. It's on you. So how do you check this? you go and pull out statements. You reach out to either a professional to do it for you, or you go pull out statements. You go and see in your inbox, your Gmails, whatever the case may be, all email addresses, you got to pull that stuff up yourself. Look even at your banking statements of all the years, pull them up and look for deposits you've made. Wherever you've paid money out or at a debit order, things like that. If any time in a year you went over one of those amounts or something like that, double taxation is going to apply. And I'm sorry about that, but that is definitely just how that works. Yeah.
Awesome. Thank you so much.
No, perfect. I know it's a crazy one, and so that's why it leans again to the whole idea about the plumber versus an electrician, guys. Right? You're in a very unique situation where you've taken a huge plunge and risk in your own life by leaving home, working abroad. Now you're starting to build real opportunity for yourself, but looking now at saying, how do I get structures in place to truly get this money to work for me while I'm here, so I can meet those personal goals that I have and that's the reason why I've even pulled you to go and work overseas. And so information is key. Information is knowledge. Gonna have to take the time to either learn it or rely on somebody who does this for people to actually bring that knowledge to you in a streamlined version for you to grab it and understand it. And so that's also part of this, the service offering to add value to the group, is that if there are these kind of moments where you're going, oh, I need to really know about this, or maybe that can add value to me, please feel free to reach out and we do some personal consultations. They're for free. It doesn't cost you nothing. And so then I can at least really help you and assess what is going on, what is value, what can be enhanced, what can be changed to find the value in your current stuff and things like that. Okay. Cool. Who's next? Number one. Hello, sorry, yeah? Hi.
Hi, I hope you can hear me. Daniel,
Yes,
right?
I can hear you. Hi there, yes.
I might have missed the first 30 minutes of your session, but
Okay.
I wanted to ask about SA retail bonds and
Yes.
how they regard tax. Do they tax you the same way as you withdrawing from a stock market account?
No, but I'm glad you asked. Yeah. It's seen as interest. So it's going to be taxed in your income. It's added to your income tax bracket. So also depending on how you receive the returns. So there are retail savings bonds. So maybe for everybody in the room who doesn't know what this is, it's actually buying government debt. That's what you're doing. So that's retail savings bonds. So when government goes and spends money for whatever they'd like to do, projects, development, corruption, whatever we love in our country, beautiful, they need to fund that debt. They need to have a way of being able to replace what they used. So what do? They let people invest in their debt. So the risk that you carry is default. If a country's GDP growth isn't related and is less than what they're spending, which has actually been prevalent since 2008, 2009 in South Africa. Big thing about that is then to make it attractive to you to actually buy this debt, they give you an interest rate. Now, when interest rates go down, bonds go up. They are not correlated. So right now in South Africa, interest rates are going down. So to make it more attractive for you to buy into these bonds, they have to increase how much they get as a return. Okay? Now, either you can have this payout as a monthly income, or you would invest a lump sum and you would select a 2-year, a 3-year, a 5-year, a 10-year, a 30-year, right? At the end of the term, you would get that lump sum back with the interest. And you see what I said there, with the interest. So if you're getting it as a monthly income, that is you getting the interest per month as an income. So a lot of people market this for retirement savings or pensioners that want to get an income, things like that, because it's a secured way to get income, beating the bank's money market rates. The fact of the matter is you're buying into government debt. Luckily now we've just got off the grey list, but if you look at S&P and Finch's views on our country's financial sovereignty, we are not very much investment grade still. right? So then you got to ask yourself, would you invest into something that is deemed by financial institutions as not investable, which is government debt? Okay. So yeah, it is taxed as an income. So as to your income tax bracket, and that's the scary thing. If we go back to this tax book, grab it here, right? And we go back to tax brackets in South African terms. And that's what I say, this would be deemed South African income, right? So here's the tax brackets. Sorry. Here they are, individuals. So individuals in 2025 and what it will be next year from the 1st of February, okay? Now let's say as an example, you're currently out there and you're earning 80,000 Rand a month as an example. That means you're earning 1050 in South African Rand terms. That means you're a 41% tax bracket owner. Now you go and invest R1 million. Yeah, so you're paying 251,000 plus 41% above 857,000 Rand. So basically that 251 includes all of those step-ups that you've incurred to get to that point. Okay. Now you go and invest R1 million and you start getting, okay, wait, there you are, 105. So, okay, that's going to be quite a stretch. Let's say, for instance, as an example, you're earning 1.5 million Rand gross. Okay. That means you're a 41% tax bracket. Now you invest R1 million and you're getting, let's say, 250,000, no, let's say 350,000 out on top of that income. Suddenly you go and you break this limit. You go over the 1.8, you jump to 45%. So now all of a sudden your tax liabilities significantly increase because of that investment, because you're getting an interest which is added to income, where maybe you would have been better off with a growth appreciation in a unit trust, where you're only subjected to capital gains with the first 40,000 exempt and only at 18% above. So that's why I also say very much in every individual has very specific needs about their holistic financial planning. What is in place, what could be in place, and what you're looking to put in place. And that defines the course of action. Not necessarily the company and the logo on the screen, not necessarily where they're doing background checks to confirm if you've got another TFSA. It comes to holistic planning and looking at everything that you want to do, what you have, what you'd like to have, and where you want to do what way. Sounds crazy, but it's true. Huge question. That was a huge question. I actually want to go to capital gains and show you guys that as well. Well, did that answer your question? Shall we move on to another question?
I think that answered my question.
Yeah?
It sounds like unit trust is a safer option.
So again, that's the thing. Safer is such a subjective word, Fred. So the big thing is this. You can invest into a portfolio that is very high risk within a unit trust. So we are talking vessels now, construct. Portfolio defines risk. So in a unit trust, you can also invest 100% into bonds, not just government bonds. You can invest into the banking sector's bonds and actually get a pretty decent return this year. We're looking at about 10% in South African terms. And that's a moderately conservative to conservative investment. That's beating the banks for low risk because interest rate cycle is dropping. So in the unit trust vessel, you can select whether you need high risk or low risk or something in between. In an endowment, you can do the same. In a retirement annuity, you can do the same. It depends, again, on each individual person. So like the individual they mentioned, like I'm of age and I'm talking and thinking retirement. That's where security needs to come to mind. To say, because there's no time to repair. There's no time to handle the loss if there is one. So a person like that is thinking, I need to make sure that there's money. I need that income, no matter what. There'll be a point in my life, and this is the thing with post-retirement planning. There's an active retirement, there's an active passive, and there's a passive retirement. At some point, you physically will not be able to do anything to generate active income, like work. If you haven't made a plan to create passive income streams, you're going to run into problems. If you want to create financial freedom for yourself, you're going to want to do that at some point. That's when your income is not related to your ability to actively make it. You want to create passive income streams. Yes.
Very sorry, my apologies. We still have people who, like 4 people who have
Lots of
hand
questions.
raised. Yeah, so can we take Pili's question, followed by Ayanda, and then followed by Lynn?
Good, let's do that. Perfect. Go right ahead.
Just to also be, oh, sorry, we have 13 minutes left, just to be
Okay,
time.
let's run with that. Sorry about that, guys, definitely. Billy, hi.
Hi, Daniel. I just wanted to go back to the double taxation topic. I need some clarity. Were you essentially saying that we are meant to be taxed on our salaries here and back home, or was that pertaining to investments? If so, someone is investing here in China.
Bit of both, actually, but no, absolutely. So you are a South African citizen, right? And you've gone abroad, and now you're earning an income. Now, if you're being taxed by the People's Republic of China, that's great. But the fact of the matter is you're still South Africa. You still enjoy the benefits and rights of being a citizen of South Africa. And for that, if you are able to earn an income, you need to support and pay tax. That's the rule and law across the world. That's capitalism. Quite frankly, socialism and communism all work on the idea that everybody pays money to the country so that the country can do the things it needs to do, whether it's to look after the people that can't pay tax or earn money or develop and grow and build society. So there is that need to declare your income that you earn in where you are, your active employment, and also if there's any interest earned, any dividends that's been withheld, things like that. So multiple of those agreements. But now between China and between South Africa, there are going to be taxation agreements because we're also together. We're part of BRICS. We're part of G20. We love China as a trading country. We also share citizens. Their citizens come and work here. Like you guys, our citizens have gone there to work there. So that is a tax income and income tax or planning. That is where I need to say to you, I'm not a tax practitioner. So I can give information about taxation, but if you've got very specific tax requirements, especially when it's international, you're going to want to get a hold of a tax specialist. I can lean into my network. I do have tax specialists that do specialize in international tax, and we could potentially bring them on board for another session in the future. But ultimately, or you can have a private consultation with them if need be. One thing I cannot discuss whether they charge for that or not. That's obviously not my realm. But very much when it comes to income tax capacity, the fact of the matter is there is going to be a need to declare that for sure.
Got it. Thanks, Daniel.
Awesome.
Right,
Next
Ayanda.
question. Hi, Ayanda.
Hi, Daniel. I asked a question on the comments, but I want to clarify something. This is regards to the TFSA. So I have a tax-free investment with Allen Gray, and I have a TFSA with Easy Equity. Now, assuming that these two are the same thing, as in it's a TFSA and it's under my name, obviously that's a bit of an issue. Now, yes. Realizing that, is it possible to transfer that to my child, or are these two separate entities?
Sure, two separate entities. The thing is, they're both in your own name.
Mm-hmm.
That's a problem. You're going to have double taxation, or you're going to have double capital gains. So my strategy there would be, you would open up a brand new one in your child's name from day one. So you got to get them a South African ID number or tax number. Obviously, you got an ID with a birth certificate, legal entity, right? Then you're going to have to withdraw from one of these TFSAs. I would say the one with the least, because that just means less money equals less tax.
Correct.
Focus then on the other one. Maximize that and maximize the child. You can't transfer ownership from yourself to a child because it's already in your ID number. And we only allowed one of these in our ID numbers. But even if I go to the tax guide, so I can show it to you in actual writing, because I think that's important. So it's going back up to the index guide. So also this is a working document. So when I do send this out for you guys to share, that you can run through this and read through this. Also, don't Don't go and study this like back to back. You'll blow your mind and it changes every year. What this will do is, if you've got a question, pop to it. That's a great way to start when it comes to tax planning, okay? Tax-free, I just want to see, there is tax-free investments. You can see over here, as from the 1st of March 2015, natural persons can invest in approved investments which include unit trusts, fixed deposits, or REITs, real estate investment trusts. These investments are subject to a lifetime limit, right? Like we've spoken, all proceeds, interest, dividends, capital gains, and disposable investments are exempt from tax. Where from annual or lifetime limits are exceeded, a penalty of 40% of the excess contribution to capital is imposed. So that's if you go over. But we're only allowed one of these in our life. So in your own ID. So that's what I'm saying. Look for the lowest one, take the knock, get it over and done with, rip off the Band-Aid.
All right. Thank you so much, Daniel.
No problem,
Thank you, Daniel.
Sure thing.
Lynn?
Yeah.
Alan?
Hi, Daniel, can you hear me?
I can, loud and clear. Hi.
Hi, my question is because you said it was our responsibility to make sure that you don't exceed that 36,000, because I've experienced the double taxation thing, so I stopped investing. But then I want to start again, but you said we should be able to see when the cutoff time is. Like you said, it's about the calendar. If you start in March, you end in February. But what do you do if it's a monthly debit order? Like, do you go and stop your debit orders, or do you consult the company you with? Maybe you're with Allen Gray or whoever, and you tell them to not deduct that month? I mean, what would
if you were going to get knocked over, yes, definitely. That's what you do. You must physically stop it. Not 1 rand extra must make it into that account. Otherwise, you're going to get hit. So you have to take control of that as the investor, because at the end of the day, you are the one paying the tax. The institutions are not going to, they're going to say, sorry, ma'am, you didn't read the terms and conditions then. You see what I'm saying? Which is terrible, but it's the truth.
Right. So me stopping it at that time temporarily with them, then does that mean that, okay, then I can still carry on the next year? Yeah.
Correct.
Okay.
So
I let them know when to take the next debit order again.
Yes. So what it is maximum 3,000 Rand a month. If you do that, then you won't have to ever worry about it until the lifetime contributions is met. And you should be seeing that on the statement that you receive to say how much your contributions were made. Or if you go onto their online platform, you log in with any of your institutions, log into your TFSA, there should be some tab that says their contributions in. Or you would pull a transaction history and it will show you money in, money out. And then all your money's in, you have to add those up. So there is, the worst case scenario is very manual. But the newer age product lines are building that in, that effective calculation, so that you can see it and know it. Others will actually even be kind enough to actually give you a warning. Now, also, if you change cell phone number, email addresses, decimal, they can't send you a letter. How is that notification going to get to you? If you're doing this directly, right? So that's the thing. You are investing directly with that institution. If you put your South African cell phone number there, but now you're in China and you got your South African or a Chinese cell phone number, and they're sending you messages to alert you, and you've chosen SMS as a form of communication, you're not getting the SMS, but it's also not their fault. You are responsible to update your details. Check.
Right.
So that.
Thank you for that. Another quick question. I know today we didn't talk about like retirement as such, but I heard you talking about if you want to move your maybe like, for example, I have a retirement annuity with FNB, but I don't feel quite safe with them. So if I want to move it, does that mean that I would have to first consult the person that the company that I'm moving to? Like how would that work, me moving? Would it be like a long process, or just like you just tell them I want my money, can I just move it, and it's not complicated?
You know what? Also, great question. Thank you, Lynn. I will say 2 things on that. Right, definitely a topic for a different day, and I think in your own capacity. Number one, just as an individual, because again, everybody's got their own specifics. But like I say, when you start talking retirement savings and stuff, that's the Pension Fund Act of South Africa. There are other rules and regulations that apply to certain things that take place. I'd love to explain all of that in detail, but in the interest of time and not overloading, I mean, we still actually didn't even really touch on wills, and we didn't even touch on trusts. And I know there was topics that we wanted. And I also feel like we've only scratched the surface of investment. So I'm hoping you guys like me and what we did today, because there is a world of information I still would love to share. And potentially we can actually have this continue in retrospect. So, but is that okay for us, Lynn, to rather look at that at a different time and offline, I think more in a private capacity? Thank you.
Yeah, that's okay. Thank you so much.
No worries, Lynn. Awesome.
Yeah.
Right.
With that being said, we probably left with 2 minutes max, and a couple of seconds. So yeah, I think Karabo, maybe would you like to do the vote of thanks, and then we can conclude, and then we see when we can actually have another session, and continue with those topics that we didn't get enough time to cover.
Yeah, thank you so much. Thanks, man, for sure. Daniel, thank you so much. Your patience and like so much knowledge you shared here with us. It's been very educational. And yeah, man, we really appreciate your time. And so Hazel has put your details on the group, and anybody wants to get in touch with you, they'll just email you there or call you and just add you on WhatsApp. I'm not sure if you're WeChat or not, because we use WeChat this side. But if not, they'll just email you or just get to you through WhatsApp. Yeah.
No, that's perfect. I'm actually going to put my details in the chat so long.
Yeah.
And okay, there's my email address, direct email. And then I'm going to put my South African cell phone number. So WhatsApp, I do have it obviously at the moment. I don't have WeChat, but I'm also very much willing to do that if it's going to help facilitate things better, like conversational for everybody. I really don't mind. I just, here locally, you guys know just as much as I do. People don't know WeChat for nothing. Even though Naspers owns 30-odd% of it and making a fortune for its investors. So, but so there's email address. And then also please feel free to, hunt me on LinkedIn, come and connect, do some research on me, please feel free to reach out. And and then we could definitely take it for there. And thank you so much for the opportunity. I really, I love the idea of sharing, learning, and teaching. And so this is a great space. There's a need here, right? So I love it. In general as well, ladies and gentlemen, feel free to maybe email me questions that you might have now. So either I can answer them directly or bring them up in the next meeting, sort of like a opening agenda. If there's a question that can add a lot of value for everybody. Sound like a plan.
Wonderful. Thank you so much, Daniel. Thank you, everybody. Thank you. Tebogo, thank you so much, man. And, really appreciate everybody's time. Have a good week, guys. Thank you so much. Bye-bye.
All right. Just
Thanks, everybody.
Sorry, before everybody leaves, just a quick question that will take 5 seconds. About the documentations that you shared, is there any that we can have access to?
Yes, please. And then actually, will you just put in the email address, or shall I send it through to Hazel? And then she'll distribute?
Send it to Hazel, then she'll share with us.
Maybe that way, because everyone can access them as a collective. So yeah, sure.
Is that better to send it to you than or where?
Yeah, send it to Hazel. It's okay.
Okay. I got you, fam. Excellent. Thanks.
All right,
excellent.
Everybody.
Appreciate it.
We appreciate
Cheers,
you
everybody.
guys.
Have a wonderful day. Thanks for your time.
Bye-bye. Bye-bye.
Lovely Sunday, everybody. Ciao.